Have you ever wondered why central banks, the institutions that are supposed to defend currencies and stabilize economies, are quietly buying gold at a pace we haven't seen in generations? Not a few bars for decoration, not a token diversification allocation, mountains of it. And here's the part that should make you sit up. Central banks don't buy gold because it's trendy. They don't buy it because it might go up. They buy it because it solves a problem they can't solve any other way. This isn't the gold rush you read about in history books with pickaxes and dusty towns. This is a modern gold rush. Silent, strategic, institutional. And it's already reshaping global finance in a way that can affect your savings, your retirement, your stock portfolio, the buying power of your income, and the rules of the game over the next decade. Today I'm going to break down what's really happening, why it's happening now, and what it means for you, without doom, without conspiracy theories, and without pretending anyone can time the exact moment the world changes. Because this isn't a single event, it's a process, and the process is well underway. Let's start with the simplest question. Why would central banks, who print money, want gold? If you understand that, everything else clicks. Central banks are the guardians of the currency system. They set interest rates. They manage reserves. They step in during crises. They're the lenders of last resort. So on the surface, you'd expect them to be the last group on earth to need gold. Gold is heavy. Gold doesn't pay interest. Gold costs money to store. Gold is inconvenient. And yet, year after year, central banks have been accumulating it at unusually high levels. That is not normal behavior. It's a signal. And when the people who run the system start buying the one asset that sits outside the system, you should pay attention. Because they're telling you something without telling you. They're voting with their balance sheets. So what are they voting for? They're voting for a world where trust is weaker, where politics can override finance, and where holding someone else's IOU as a reserve asset is no longer as safe as it used to be. That's the core idea. Gold is not just a commodity in this context. Gold is a neutral reserve asset, and neutrality has become valuable again. To understand why this matters for you, you need to understand what a central bank reserve is and why it exists. Every country needs reserves to function smoothly in the global economy. Reserves are what you use when you have to pay for imports, defend your currency in a crisis, settle trade imbalances, or stabilize your financial system. For decades, the dominant reserve asset has been the US dollar and US government bonds. Why? Because the dollar has been the world's settlement currency, because US Treasury markets are deep and liquid, because the US has historically been viewed as the safest borrower, and because the entire global trade system was built around the dollar after World War II. So for most countries, the safe choice was simple. Hold dollars, hold treasuries, hold assets linked to the dollar system. But something changed in the last few years, not gradually, suddenly. And that something was the realization that reserves aren't just financial, they're political. If a country's reserves can be frozen, blocked, seized, or made unusable during conflict, then those reserves aren't truly risk-free. They're conditional. That is the key shift. And when reserve managers start thinking in terms of conditional access, they start looking for an asset with one special feature. No issuer, no counterparty, no permission required. That asset is gold. Now let's talk about the moment that changed the psychology of central banks. In the early 2020s, a major geopolitical conflict led to unprecedented financial actions. Large pools of foreign currency reserves were frozen. Again, your politics don't matter here. This isn't about who you support. This is about what the action taught the world. It taught every reserve manager on earth one simple lesson. If it can happen to them, it can happen to us. And once that thought exists, the reserve game changes. Because reserve assets are supposed to be what you rely on in the worst-case scenario. If the worst-case scenario is precisely when your reserves might be blocked, then you don't really have reserves. You have a polite illusion. Gold doesn't fix every problem, but it fixes that one. Gold can be held domestically. Gold can be held outside someone else's jurisdiction. Gold cannot be printed away by another central bank. Gold cannot be canceled with a political decision in the same way a bank account can. So central banks began doing what central banks always do when the regime changes. They adapted, quietly. And they adapted by accumulating gold. But it's not only about geopolitics. There's another reason central banks are buying: debt. Because the entire modern financial system has a debt problem that doesn't have a politically painless solution. Governments, especially large ones, have accumulated enormous debt loads over decades. And when debt is that high, policymakers face a very limited menu of choices. Option 1, default. That destroys credibility, markets, and trust. Option 2, austerity. That's politically unpopular and often economically painful. Option 3, massive tax increases. That has limits and it triggers avoidance, capital flight, and behavioral change. Option 4, reduce the real value of the debt over time through inflation and financial repression, meaning keep the system running but slowly erode the purchasing power of the currency so the debt is easier to service in real terms. Historically, the most common path is some version of option 4, not necessarily Weimar-style hyperinflation. More often, long periods where money buys less, wages lag, assets rise, and savers lose quietly. Central banks understand this. They don't need to guess. They can see government math. So what do you do when you expect a long period of currency debasement? You diversify into assets that can't be printed. Gold is the most traditional version of that. So yes, geopolitics matters. But the debt and money printing trajectory matters too. And when you combine both pressures, central bank buying becomes more understandable. They're hedging the system they manage. That sounds strange, but it's true. They run the system, and they're still hedging it. That alone should tell you something. Now let's address a confusion that many people have. They see gold rising and they assume, that must mean a crash is coming. Not necessarily. Gold can rise in multiple environments. Gold can rise when fear spikes, yes. But gold can also rise when real interest rates are falling, when the currency is being diluted, when central banks are accumulating, when reserve managers are diversifying, when bond investors start questioning long-term purchasing power. Gold rising doesn't always mean apocalypse tomorrow. Often it means a gradual shift in confidence, a repricing of money, a change in what institutions view as safe. And that's why you can see a world where stocks do fine and gold still rises. Because gold isn't competing with stocks in that moment. It's competing with currency credibility. It's competing with bonds. It's competing with the idea that holding paper claims is the best long-term store of value. When that idea weakens, gold doesn't need a stock market crash to perform. It just needs the system's baseline trust to erode. So what does this mean for you? It means the risks in a normal portfolio are shifting. Most people are positioned for a world where cash is safe, bonds are safe, stocks go up over time, inflation is managed, and the currency is stable enough that you don't think about it. But if central banks are buying gold at record pace, they're signaling a different world, a world with more fragmentation, more political risk, more volatility in trade relationships, more currency competition, more incentives to debase rather than default. In that world, the biggest risk isn't your portfolio goes to zero. The biggest risk is that you work hard, save diligently, invest normally, and still fall behind in purchasing power. That's the silent killer. You don't notice it in a month. You barely notice it in a year. But over 5, 10, 15 years, it compounds. It shows up as housing affordability collapsing, insurance costs rising, healthcare becoming heavier, education getting harder, groceries feeling permanently inflated, and your safe savings not keeping up. Meanwhile, asset owners do fine, because assets reprice. That's how wealth transfers during monetary shifts, not through one dramatic crash, through years of compounding differences. Now, before we go further, let's clear up a myth. When people hear central banks buying gold, they imagine a dramatic reset where paper money dies and gold becomes the currency again. That's unlikely. Modern economies won't fully return to a classic gold standard. A strict gold standard is too rigid for modern credit systems and political realities. But you don't need a gold standard for gold to play a larger role. You just need gold to be treated as higher quality collateral. You just need reserve managers to keep accumulating it. You just need institutions to treat it as a hedge against currency and political risk. That alone can support a long supercycle. So the point isn't gold replaces the dollar. The point is, the world becomes less dollar-centric, and gold becomes more important as neutral collateral between blocks. That's a big shift, and it has consequences. Let's talk about those consequences in plain terms. Consequence 1. long-term support under gold prices. When central banks buy, they often buy steadily and quietly. They don't chase daily headlines like retail. They don't panic sell because of a bad week. They accumulate over time. That steady bid matters. It reduces the probability of long, deep bear markets in gold, though it doesn't eliminate volatility. Consequence 2. Pressure on currencies and bonds. If reserve managers slowly reduce the share of reserves held in dollars and increase gold, that can contribute to long-run shifts in global demand for dollar assets. Again, not overnight, but marginal demand moves price at the edge. If the marginal buyer changes behavior over years, the system changes. Consequence 3. Inflation dynamics become more complex. When supply chains fragment, when trade routes shift, when geopolitics affects energy and commodities, inflation becomes stickier. Gold tends to benefit in that type of environment, especially when policymakers choose to manage debt through mild but persistent inflation. Consequence 4. Asset prices inflate, but living costs can also rise. This is the uncomfortable part. Markets can go up while people feel worse. Why? Because the stock market is not the economy. And when money is abundant but unevenly distributed, assets reprice faster than wages. This is how inequality can widen during monetary transitions. So if you want to protect yourself, you need to understand one simple rule. In inflationary or debasement-prone regimes, owners tend to win and savers tend to lose. Which leads to the practical question, what do you do? Here's how to think about positioning without getting extreme. The goal is not to bet your entire future on one outcome. The goal is to build a portfolio that survives multiple outcomes. Because nobody knows the exact timing of regime shifts. Central banks can buy for years before the public notices. Markets can stay irrational. Policy can surprise you. Growth can stay strong longer than you expect. Or shock can hit faster than anyone expects. So you need a framework that doesn't require perfect prediction. Here's a practical framework. First principle, don't make one big bet. If you put everything into gold, you expose yourself to volatility, opportunity cost, and policy risk. If you put everything into stocks, you expose yourself to valuation and rate risk. If you put everything into cash, you guarantee purchasing power erosion over time in an inflationary regime. So instead, you build a mix. Second principle, own productive assets. High-quality companies with pricing power tend to be resilient. Pricing power means costs go up, they can raise prices. They can protect margins, they can adapt. Not every stock is a protection asset, but some businesses are built for inflationary environments. Third principle, own some real assets. Real estate where appropriate, commodity exposure where appropriate, and a measured allocation to monetary metals as insurance. You're not trying to get rich from insurance. You're trying to avoid being ruined by currency math. Fourth principle, keep liquidity for life. This is underrated. People blow up not because they're wrong on the big picture, but because they're forced to sell at the wrong time. Keep emergency funds. Avoid leverage. Avoid positions so large that a normal drawdown breaks you psychologically. Fifth principle, choose your gold exposure intelligently. If you want gold as insurance, understand the difference between physical gold you control versus paper gold claims versus complex products with counterparty layers. For many investors, the point of gold is precisely that it reduces counterparty risk. So if your gold exposure adds counterparty risk back in through layers of claims, you defeat the point. That doesn't mean all paper is bad. It means know what you own and what you can access. Also think about practicality, small denominations versus large bars, storage costs, jurisdiction, documentation. Boring details matter when you're using gold as insurance. Now let's talk about what you should watch to know if this silent gold rush is accelerating. Because you don't need to guess. There are signals. Signal 1. Central bank purchase trends. If central banks continue buying heavily year after year, that's confirmation of a structural shift. Signal 2. Real interest rates. Gold tends to perform better when real rates are falling or negative. When cash and bonds fail to keep up with inflation, gold becomes more attractive. Signal 3. Reserve diversification headlines. When countries openly talk about diversifying reserves, building alternative settlement systems, or reducing dependence on one currency, it's part of the same shift. Signal 4. Repatriation. When countries move gold home, it signals rising concern about jurisdictional risk. It's about control. Signal 5. Money supply and deficit trends. If governments continue running large deficits and central banks maintain accommodative policies, debasement pressures remain. Signal 6. The crowd. This is the psychological signal. When people who never cared about gold start asking about it at dinner parties, the market is in a different phase. We are not fully there yet. That matters. Because supercycles don't end when institutions begin buying. They end when everyone believes it's obvious. Now, one more critical point. Silver. Even though today's topic is gold, silver often behaves like the stress sensor of the metals complex. Silver is smaller, more volatile, more industrial, and more prone to sharp squeezes when physical tightness builds. Gold can rise gradually as a reserve asset. Silver can explode when physical demand collides with thin liquidity. So if you're watching the metals story, don't just watch price. Watch physical stress indicators, premiums, delivery tightness, inventory trends, and spreads between immediate delivery and future delivery. Those are early signals of strain. And strain is what turns a slow story into a fast story. So let's bring this home. What does this silent gold rush mean for you? It means you should stop thinking of gold as a weird doomsday hobby and start thinking of gold as a signal. Central banks are telling you that the world is getting more fragmented, more debt-heavy, and more politically sensitive. They are preparing for a world where neutral collateral matters. That doesn't mean your life is over. It doesn't mean your stocks are doomed. It means the background rules are changing. And when rules change, you adjust. Not with panic, with structure. You don't need to predict the exact day the next regime begins. You just need to avoid being the person who ignores the signal for 10 years, and then wonders why their savings didn't keep up with life. Because the silent gold rush is not just a story about gold, it's a story about money. And money affects everything. Let's summarize in one clean checklist. Central banks are buying mountains of gold because trust in reserve assets has become conditional and political. Debt levels make currency debasement the path of least resistance. Gold is neutral, issuer-free collateral in a fragmenting world. And what it means for you is protect purchasing power over long horizons. Avoid all-in bets. Hold productive assets with pricing power. Consider measured insurance exposure. Keep liquidity so volatility can't force bad decisions. And watch signals, not narratives. That's it. No doom, no fantasy, just pattern recognition. If you want to do one practical thing after this video, do this. Look at your portfolio and ask one honest question. If the currency slowly buys less over the next decade and asset prices keep inflating, am I positioned as an owner or am I positioned as a saver? That single question will change how you think. Because this silent gold rush isn't waiting for permission, it's already happening. And the people who notice early don't need to panic later.